Alright, so this video will be going over how to use fair value gaps to spot reversals, particularly ones that put us back into higher time frame trends. So this first example is from NASDAQ on June 1st. Now if we look at the 1 minute chart, we can see that this meets the criteria to short via the ICT mentorship model. We have a move above buy-side liquidity, an energetic move down coupled by market structure break right here, retracement back into a 1 minute fair value gap, and that's the short signal. If you're wondering where these levels are coming from for buy side and sell side, this is the hourly chart that I'm pulling it from. But let's say you missed this entire first move down. I mean, there was only a total of 3 minutes to catch it. Say you missed that and we're looking for some continuation to hit sell side. So first of all, we can zoom out to the 5 minute chart, and looking at this 11 a.m. reversal specifically, is there anything we could have seen on this chart as an actionable signal to short for a continuation lower? Well, we do have a 5 minute fair value gap right here. Now, what if we zoom out to the 10 minute chart? Do we have anything similar? Yes, we have a fair value gap right here. Now, if we combine the two, 5 and 10 minute fair value gaps, this is what we get. We have this sort of overlapped area where we have the 5 and 10 minute fair value gaps, suggesting that this could be an area to watch for reversals. Now, if we zoom out one more time to the 15 minute chart, which is usually pretty significant for fair value gaps and imbalances, we again have another fair value gap right here, which we can add to our overlap, and this becomes our kind of composite view. So from all this information, we can define an area of interest where fair value gaps are overlapping on, let's say, 2 or more time frames, and this is what it would look like. Now, how could we actually use this to trade the setup? Well, if you were a conservative trader, you could wait for some actionable signal like a reversal on the 5 minute chart once price has entered and rejected this area of interest. If you put your stop at the high of the candle that created the fair value gap, this would give you roughly 3-to-1 risk to reward to target sell side liquidity. If you were more aggressive, maybe you could enter a short position once price enters that area, with your stops and targets being the same. That would turn into a 5-to-1 trade. Now let's look at another example from May 13th. Starting again with the 5 minute chart, is there anything we could have seen to let us know that this afternoon pullback was a buying opportunity? Well, we do have a 5 minute fair value gap. What about on the 10 minute chart? We see the same thing right here. If we put the two together, this is what we get. And what about the 15? We see the same thing right here. Price pulls back, hits this fair value gap. And this is what the composite looks like again. And for this trade in particular, we can actually take another step back and see the hourly chart. We have a fair value gap as well, and kind of adds to our overall view, creating our area of interest right here, everything in this white rectangle. And so another factor of confluence for this trade could be that this afternoon pullback started to base at a 50% retracement of the morning move. So with all that information, again, how would you trade this? If you were more conservative, you wait for the actionable signal, like a break of this inside 5 minute hammer candle's high, using the lows of the candle that created the fair value gap and targeting the high of the day. This would be roughly 2.5 to 1 trade. If we were more aggressive, we could enter in the area of interest, making this more of a 4-to-1 trade roughly. One more quick example from May 23rd. We do have a midday pullback into a 5 minute fair value gap right here. We also have a 10 minute fair value gap that we can add. There are no 15 minute fair value gaps in this particular example, but we do fall again to a 50% retrace of the morning move. So we can enter long on this 5 minute hammer reversal, targeting high of the day, stops at the lows of the candle that created the fair value gap, making this a 2-to-1 trade, or we can enter in the area of interest again and increase our risk to reward to 3-to-1. And later that day, we also have another small opportunity here where price trades back into another 5 minute fair value gap. There's also a 10 minute fair value gap from this box. And if we were looking to buy on a reversal of the 5 minute chart, that would give us a roughly 2-to-1 trade to see the high of the day. Or if we bought in the area of interest, it would be more of a 4-to-1 trade. So to recap, fair value gaps that line up on multiple time frames can create high probability reversal zones. Doesn't mean they always will, it's just something to look for. An area of interest can be created when fair value gaps are lining up on 2 or more time frames. That can kind of give you an idea of where to add, kind of like your confluence zone. And these areas can be used to catch low time frame reversals in the direction of a higher time frame trend. Notice if you go back to the examples, we were looking at a big morning move, a pullback, and then continuation back into the high of the day or low of the day, depending on what the initial direction was. And lastly, just do your own backtesting and see if it works for you. I mean, don't take my word for it. Go into your charts and see where these setups appear and if they would have worked. Experiment with different time frames and see what works best for your style. You could do maybe the 1 minute, the 3 minute, and the 5 minute. If you want to do some lower term timeframes, because again, this is best for continuations rather than just catching that initial reversal once we cut through some liquidity zone and then reverse back through it. But anyway, if you guys did find this video useful and show some support, then I'd definitely be open to making maybe like a longer form video where we backtest this whole thing for, say, the last month or so on index futures, so we can see a bunch of examples of where it worked and where it didn't and what we can learn from all that. But again, if you did find this helpful, please like, comment, subscribe, and I'll see you in the next one.